In a Manhattan courtroom in 2003, an exhibit was projected onto a screen for a jury and a bank of reporters. It showed a circular diagram, natural gas flowing from Enron through a Jersey-registered entity called Mahonia Ltd to Chase Manhattan Bank, and cash flowing back around the loop in the opposite direction. An investigator pointed to the delivery dates and the repayment dates and noted that they matched to the day, with a fixed spread built into the pricing that behaved like an interest rate. According to the record developed in the surety litigation and the later regulatory proceedings, no molecule of gas ever moved through any of it. The structural question is this: how does a loan get recorded as trading revenue, and what has to be true about an accounting rulebook for that transformation to survive an audit? This episode is about the prepaid forward commodity contract. The instrument at the center of the Enron prepay transactions was not exotic on its face. A prepaid forward is a legitimate and common commercial arrangement. Understand it in its clean form first, because the fraud is not a new instrument. The fraud is the removal of one element from a standard contract, and the consequences of that removal cascading through the accounting. A forward contract is an agreement to deliver a commodity at a future date for a price set today. A prepaid forward simply moves the payment forward. Instead of paying on delivery, the buyer pays at the outset in a lump sum, and the seller delivers the commodity later over a schedule. Producers use these constantly. An oil and gas company that needs cash today and expects to produce gas over the next several years can sell that future production now, receive cash now, and satisfy the contract later by delivering the physical commodity. Economically, the producer has monetized future output. There is nothing improper in this. It is a financing, yes, but it is a financing collateralized and settled by a real commodity that the seller genuinely intends to produce and deliver. The accounting treatment for a genuine prepaid forward reflects that reality. When Enron entered a legitimate prepaid forward as a seller, it received cash and recorded a liability, an obligation to deliver gas or oil in the future. This is the key point. The cash comes in, but so does an offsetting obligation. Under the accounting standards in force, a prepaid delivery obligation was recorded as a form of deferred revenue or a delivery liability, and it did not become revenue until the commodity was actually delivered. The transaction did not flow through cash flow from operations as if the company had earned it by trading. It sat on the balance sheet as what it was, a promise to hand over gas later in exchange for money received now. Now hold that clean structure in mind, because the distortion is precise. The legitimate prepaid forward has two parties and price risk. The buyer takes the risk that gas prices fall, and the seller takes the risk that prices rise, or the price is fixed and both accept it. There is a genuine commercial contingency. The delivery is real. The commodity is expected to move. The Enron Prepay, as constructed with Chase Manhattan Bank and later JPMorgan Chase, and as documented in the surety litigation and in the consent order Chase entered with the SEC in July 2003, removed the commodity risk entirely while preserving the surface appearance of a commodity trade. What made this possible structurally was the interposition of a third entity, Mahonia Ltd, a company registered in Jersey in the Channel Islands. Mahonia was not, in economic substance, an independent commodity counterparty. According to the SEC's findings, it functioned as a conduit. It existed to make a two-party financing look like a three-party series of commodity trades. Here is why the third party mattered. If Chase had simply lent Enron money against future gas delivery, that is a loan, and it would be recorded as debt. If Enron had entered a prepaid forward directly with Chase and the commodity risk had been real, that too would have carried a delivery obligation on the balance sheet, and its cash proceeds would not have counted as operating cash flow from trading. The point of the structure was to sever the appearance of a loan from the accounting for a loan. The three-legged circle accomplished this. Each individual contract in the circle looked like an ordinary commodity forward. Only when you assembled all three did the loan reappear, and by design, no single party's books assembled all three. That is the mechanism stated plainly. A prepaid forward is a financing wearing the clothes of a commodity trade. When the commodity risk is genuine, the clothes fit the body. When the commodity risk is engineered out through a matched, offsetting set of contracts routed through a conduit, the clothes remain, but the body underneath is pure debt. The fraud is the gap between the clothes and the body, and the accounting recorded the clothes. Now, the architecture. Walk the circle one leg at a time, because the geometry is the whole story. Step 1. Chase Manhattan Bank paid a large lump sum to Mahonia Ltd. In exchange, Mahonia committed to deliver a fixed quantity of natural gas or oil to Chase over a future schedule. On Chase's books, this looked like a prepaid forward purchase. Chase was the buyer, prepaying for future commodity delivery. Money moved from Chase to Mahonia. Step 2. Mahonia, on the very same day, entered a mirror image contract with Enron. Mahonia paid the lump sum to Enron. In exchange, Enron committed to deliver the same fixed quantity of the same commodity to Mahonia on the same schedule. Money moved from Mahonia to Enron. Note that Mahonia is now flat. It received cash from Chase and passed it to Enron. It has an obligation to deliver gas to Chase and an offsetting right to receive gas from Enron. It bears no net commodity position and no net price risk. It is a pass-through. Step 3. Enron entered a third contract, closing the loop. This is the leg that eliminated the commodity risk entirely. Enron agreed to repurchase or to make fixed payments back through the chain on a schedule that matched the delivery obligations to the day. In the fully engineered version documented in the record, the physical delivery obligations were offset by financial swaps and repurchase commitments so that no gas ever needed to move. Enron owed a stream of fixed payments back to Chase, routed through Mahonia over a defined term. Those payments equaled the original lump sum plus a spread. Look at what has been built. Enron received a lump sum of cash up front. Enron committed to pay it back over time with a spread on top. The spread was fixed and did not vary with the price of gas. Assemble those two facts and you have described a loan. The lump sum is principal. The spread is interest. The schedule is the amortization. According to the SEC, the prepay transactions functioned as loans, and the record establishes that the parties understood them as financings. But no single set of books showed a loan. On Enron's books, the structure was recorded not as debt, but as commodity trading activity and as obligations under price risk management contracts. The cash Enron received flowed into cash from operating activities. This is the accounting outcome that mattered most. Enron was under relentless pressure to show operating cash flow because analysts and rating agencies scrutinized the relationship between reported earnings and the cash those earnings generated. A company reporting large profits with weak operating cash flow raises questions. The Prepay transactions closed that gap. They converted borrowed money into what looked like cash generated by the trading business. Consider the scale. The SEC's July 2003 settlement with JPMorgan Chase, entered without admission or denial of the findings, established that the bank paid $135 million to settle charges arising from its role in the Enron Prepay transactions. The Commission's findings described a series of prepay deals executed over several years. According to the examiner's work in the Enron bankruptcy and the materials developed in the litigation, the prepay structures collectively moved billions of dollars of what was, in substance, borrowing onto Enron's books as something other than debt. The exact aggregate figure varied across the deals and the counterparties, because Chase was not the only bank running this structure. Citigroup ran a parallel version through an entity called Delta, but the mechanism was identical, and the Mahonia leg is the clearest documented example. Return to the conduit. Why Mahonia? Why Jersey? The role of the third entity is the load-bearing element of the whole architecture, and it is worth being precise about what it accomplished. If Chase had contracted directly with Enron, a matched pair of offsetting commodity contracts between the same two parties would have been difficult to characterize as anything but a financing. Two contracts, same parties, offsetting obligations, matched dates, a fixed spread. Any auditor looking at the pair together would see the loan. The interposition of Mahonia broke the pair into two separate two-party relationships. Chase to Mahonia looked like one legitimate prepaid forward. Mahonia to Enron looked like another separate prepaid forward. The offset lived only in the aggregate, across a party that appeared on nobody's consolidated balance sheet as a related entity. The record addressed the question of Mahonia's independence directly. The surety companies that had guaranteed some of these obligations argued in litigation that the transactions were disguised loans and that the sureties should not have to pay, because they had guaranteed commodity performance, not loan repayment. The evidence developed in that dispute went to how Mahonia was established, controlled, and used. Chase entered the SEC consent order in 2003 addressing its role. The structural finding was that Mahonia functioned to help Enron characterize financings as trading activity. The commodity leg was, in the fully engineered deals, a formality. Physical settlement was not the point. The loop was the point. There is one more architectural feature to name, because it is where the price risk was neutralized. In a genuine prepaid forward, the buyer who prepays for gas is exposed to the price of gas at delivery. If Chase truly bore that exposure, the transaction would carry real commodity risk and would be harder to characterize as a loan. The record establishes that Chase's exposure to commodity price movement was hedged out through offsetting swaps, so that Chase's economic return was the fixed spread and the return of its principal, independent of what gas prices did. Strip the price risk from a prepaid forward, and you have removed the last thing distinguishing it from a loan. What remains is a fixed sum out, a larger fixed sum back over time, and a schedule. That is credit. That is not a commodity trade. So the completed architecture reads as follows. A conduit with no independent commodity purpose sits between the bank and the company. Cash flows one direction around the circle. Delivery obligations flow the other. Price risk is hedged to zero. The spread is fixed and behaves as interest. Each two-party leg is individually defensible as a forward. The financing character appears only in the assembled whole, which no single ledger assembled. On Enron's books, the proceeds landed in operating cash flow, and the obligation to repay did not land in reported debt. It was disclosed, if at all, as price risk management liabilities, which analysts did not read as borrowing. Why did the gatekeepers miss this, and for so long? This is not a question about individual failure. It is a question about where the verification chain was structurally blind. Begin with the auditors. The external audit function verifies that a company's financial statements conform to generally accepted accounting principles. An auditor examining a single prepay contract on Enron's books would see a commodity contract. The contract would reference gas, quantities, delivery schedules, and pricing. On its own terms, it was a commodity transaction, and there existed a legitimate accounting treatment for commodity transactions. The auditor's task was to determine whether the accounting matched the form of the contract in front of them. It did. The form was a forward. The accounting was forward accounting. The verification failure sits in the word substance. Accounting principles have long held that transactions should be recorded according to their substance, not merely their legal form. A financing dressed as a trade should be accounted for as a financing. But applying the substance principle to the prepay transactions required the auditor to do something the structure was specifically engineered to prevent: to assemble all three legs, recognize the offset, identify Mahonia as a conduit rather than a counterparty, and conclude that the substance was a loan. To reach that conclusion, the auditor would have had to look beyond Enron's own contracts to the mirror image contracts held by Chase and by Mahonia, entities whose books the auditor did not audit and could not compel. This is the structural point about conduit financing. The offset is invisible from any single vantage. The auditor of Enron saw an Enron-facing contract. The auditor of the bank saw a bank-facing contract. Neither had the complete circle in view unless they went looking for it and had the authority to obtain it. For detection to occur early, someone with a complete view of all three legs would have had to assemble them and insist that the substance over form principle overrode the form of each individual contract. The record does not establish that this assembly occurred within the audit chain during the years the transactions were live. Now, the rating agencies. Enron's investment-grade rating was existential. The prepay transactions were partly in service of preserving that rating, because the structure kept borrowing off the reported debt line and improved the coverage ratios the agencies watched. The agencies analyzed Enron's reported financial statements. If those statements classified the prepaid proceeds as operating cash flow and did not classify the repayment obligation as debt, then the ratios the agencies computed reflected that classification. The agencies were, in effect, fed inputs that had already been transformed by the structure. Detecting the true leverage would have required the agencies to reconstruct the economic reality behind the reported figures, to identify the prepays as debt, and to add billions back to the debt figure. The record establishes that this reconstruction did not occur in time to affect the ratings before the collapse. Consider the analysts. Equity analysts covering Enron faced a company whose reported cash flow appeared to validate its reported earnings. The prepay transactions were designed precisely to make that validation appear. An analyst suspicious of Enron's earnings quality would look to cash flow as the check, and the prepays corrupted the check itself. The one metric an analyst would use to test whether reported profits were real had been engineered to pass the test. This is the most elegant and the most damaging feature of the mechanism. It did not merely inflate a number, it corrupted the number that other numbers were checked against. And the banks. Chase and the other institutions on the other side of these transactions were not passive. The SEC's findings established that the banks understood the financing character of the deals. The 2003 consent order addressed Chase's role in helping Enron present financings as trading activity, but the banks were counterparties, not gatekeepers. Their incentive was to earn the spread and the fees. Nothing in the counterparty role obligates a bank to correct the accounting treatment its counterparty applies on its own separate books. The gatekeeping function the banks might have served, refusing to participate in a structure whose purpose was accounting distortion, was not a function the market imposed on them at the time. The enforcement action that followed established, after the fact, that participation carried liability. It did not exist as a constraint during the transactions, so the detection failure was not a single missed signal. It was the compounding of 4 structural blindnesses. The auditor saw form and could not assemble substance across entities it did not audit. The rating agencies consumed transformed inputs. The analyst's check metric was itself the thing corrupted. The banks had no gatekeeping duty and a direct incentive to proceed. For early detection, the substance of the full circle would have had to be assembled by a party with both the complete view and the authority and motive to act on it. No such party existed within the verification chain until an examiner was appointed after the collapse, with subpoena power and a mandate to reconstruct. That is the general lesson the case establishes about conduit structures, stated as a structural observation rather than a moral one. A transaction engineered so that its true character appears only in the aggregate across multiple entities defeats a verification system built to examine entities one at a time. The blindness is not a lapse. It is a design feature exploited. What triggered the unraveling? The prepay mechanism did not collapse on its own terms. It collapsed because the entire Enron structure lost the thing that kept every off-balance sheet arrangement standing: the investment-grade credit rating and the stock price that supported the related party vehicles. The sequence began in the autumn of 2001. On October 16, 2001, Enron reported third-quarter results and disclosed a large reduction in shareholders' equity connected to the unwinding of certain related party structures. This began the loss of market confidence. As the stock fell and the disclosures accumulated, the rating agencies moved toward downgrade. The prepay transactions were connected to this cascade in a specific way. Many of Enron's financing structures contain provisions triggered by a ratings downgrade or a fall in the stock price. A downgrade to below investment grade would accelerate obligations across the structure, demanding cash the company did not have. On December 2, 2001, Enron filed for bankruptcy. It was at that time the largest corporate bankruptcy in United States history. The prepay obligations, which had been recorded as commodity contract liabilities rather than as debt, now had to be reckoned with by creditors, by the bankruptcy examiner, and by the courts. The clearest forensic exposure of the prepay mechanism came through 2 channels. The first was the bankruptcy examination. The court-appointed examiner, with subpoena power, was able to do precisely what no gatekeeper had done in real time: assemble all the legs of the circle and characterize the substance. The examiner's reports set out how the prepay transactions functioned as financings and quantified the extent to which they had disguised borrowing as operating cash flow. This was the assembly the audit chain could not perform, now performed by an officer of the court with the authority to compel the documents from every party in the loop. The second channel was the surety litigation. Before Enron's collapse, Chase had obtained surety bonds guaranteeing performance of the commodity delivery obligations in the prepay chain. When Enron failed, Chase sought to collect on those bonds. The surety companies refused to pay, and their defense was structural. They argued that they had guaranteed the performance of genuine commodity contracts, and that what they had actually been asked to backstop were disguised loans. Guaranteeing a commodity delivery is one risk. Guaranteeing loan repayment is a different risk, one the sureties said they had not agreed to and would not have priced the same way. This litigation forced the mechanism into open court. To determine whether the sureties owed payment, the court had to determine what the transactions actually were. The circular diagram described at the opening of this episode was an exhibit in service of exactly that determination. The matched dates, the fixed spread, the conduit with no independent commodity purpose, the hedged-out price risk. Each of these was evidence that the substance was a loan and the commodity form was a device. The surety dispute ultimately settled, but the evidentiary record it generated established the financing character of the deals in a public forum. Then came the regulatory conclusion. In July 2003, the SEC announced settled enforcement actions arising from the prepay transactions. JPMorgan Chase agreed to pay $135 million, and Citigroup agreed to pay a comparable sum in connection with its parallel structure in settlements entered without admission or denial of the Commission's findings. The Commission's findings described the prepay transactions as financings that Enron accounted for as trading activity and described the bank's role in facilitating that characterization. The Federal Reserve and the New York State Banking Department also entered into agreements with the banks addressing these structured finance transactions. The mechanism, invisible to the verification chain while it operated, was named and characterized by the enforcement record once it was assembled. The collapse of the mechanism, then, was not the failure of the prepay contracts themselves. Individually, as commodity contracts, they were performing or capable of performing. The collapse was the collapse of the entity that had used the structure to disguise its leverage. Once the credit rating fell and the bankruptcy came, the true debt could no longer be hidden in the operating cash flow line, and the examiner and the courts reconstructed what the structure had been all along. The exposure was retrospective. The instrument did not detonate. The disguise simply became unnecessary once the company was in liquidation and the reconstruction followed. What does this case establish about the mechanism as a matter of structure rather than verdict? First, it establishes that the accounting treatment of a transaction can be driven by its legal form even when its economic substance is known to the parties, and that a sufficiently engineered form can survive examination by a verification system built to test one entity at a time. The prepay transactions were not hidden in the sense of being undisclosed. They were disclosed as commodity contracts. The distortion lived in the classification, and the classification followed the form. The substance over form principle existed in the accounting literature, but its application required assembly that the structure was built to prevent. Second, it establishes the specific danger of a financing that improves the very metric used to detect financing distortion. The prepay proceeds landed in operating cash flow, which is the metric analysts use to validate earnings quality. A mechanism that corrupts the check itself cannot be caught by the check. This is a general structural property, not a feature specific to Enron. Any transaction that inflates the diagnostic used to detect inflation is, by construction, resistant to that diagnostic. Third, it establishes the role of the conduit entity as a device for distributing a single economic transaction across multiple legal relationships so that its character disappears from any single vantage. Mahonia held no net position and bore no net risk. Its function was topological. It converted a loop into two arcs, each of which was individually defensible, and the loop existed only when the arcs were joined by a party with the full view. The direct regulatory consequences were specific. The Sarbanes-Oxley Act, enacted in July 2002 in the wake of Enron and related collapses, required executive certification of financial statements and strengthened the responsibilities around internal controls and disclosure. It created the Public Company Accounting Oversight Board to supervise the audit profession that had, in this case, verified form without assembling substance. Accounting standard setters moved toward requiring that transactions structured to achieve off-balance sheet treatment be scrutinized for their economic substance, and the treatment of special purpose and structured entities was substantially revised. The SEC's structured finance enforcement actions established for the participating banks that facilitating a counterparty's mischaracterization of financings carried liability, converting the absent gatekeeping duty into a documented exposure. The finding, stated as a forensic review states findings, is this: the Prepaid Forward was a legitimate instrument. Its legitimate form carried real commodity delivery and real price risk, and its accounting reflected a delivery obligation, not earned revenue. The Enron prepay transactions removed the commodity risk through a hedged, matched circle routed through a conduit, retaining the form of a commodity trade while achieving the substance of a loan. The proceeds were recorded as operating cash flow. The obligation was not recorded as debt. The verification chain, examining each entity and each contract in isolation, could not assemble the circle. The circle was assembled after the fact by an examiner with subpoena power and by a court adjudicating a surety dispute, and the enforcement record characterized the transactions as financings. The mechanism was not a new instrument. It was the removal of one element, price risk, from a standard contract and the routing of the remainder through a third party, so that the resulting loan appeared on no single set of books as a loan.